What's up, everyone? Thank you all for joining the video today. I'm going to be diving into 5 companies that I've been looking into. Some of them I've been buying, some of them I need to do more research on. But without further ado, this is going to be a lengthier video because I'm going to go over 5 different companies, at least at a high level view. So let's dive right into it. So today we're going to be taking a look at Intel, Facebook, Corsair, Teradyne Inc., and of course Footlocker. And if you're interested in anything specifically, you don't want to watch the whole video, there's going to be really a chapter down below that you can click on if you want to see a company specifically. And let's dive right into this. So first things first, we're going to take a look at Intel. I have the iPad in my hand, so if you see me looking away from the camera, that is going to be why. Now, the first thing I want to point out is that Intel is a huge just semiconductor player, and it's one of the biggest manufacturers in the semiconductor space, and they manufacture obviously the Intel chips that you have in your computers. They also have a couple other chips that they manufacture for enterprise services and all those kinds of things. Now, as far as the breakout of the revenue for Q4, I'm going to pop it up on the screen here. You have the client computer group. That's going to be sort of your normal consumer CPUs or anything that's related to that. And then obviously your data center group is going to be their enterprise software and their server items. Internet of Things is just going to be a combination of a bunch of different products that they're trying to come out with. Mobileye, it's going to be their AI that they're actually going to be spinning off and IPOing. So they're going to have a huge cash inflow from that. And Mobileye has been working with AI on car driving. And I think that's going to be one of the biggest things. And obviously Programmable Solutions Group, that is another one of their services that they offer. So I think that overall, though, Intel is a very, very, very big player. And I think that the current valuations, you're going to see here in a moment why I like it. Now, their total revenue for 2021 was $74 billion, and they expect it to stay at around that going forward, at least for the near term. And then obviously they have a dividend. They have done some buybacks in the past, but Pat Gelsinger is their new CEO. He's amazing, and he's really fired up this company. He's firing on all cylinders, and he really likes what he does. He's very enthusiastic. If you ever get to see an interview with him, I definitely would look at a couple of these interviews, especially more recently, because he is doing a great job with the company. Now, as far as their buybacks, they're not going to be doing reshare or purchasing any of their shares, at least right now. They haven't announced anything, but they're going to keep their dividend, and Pat Gelsinger has been very adamant about keeping that dividend to keep a good, stable stock. Now, how they're really gonna develop their company and build it forward, they are doing what is called IDM 2.0. So they're gonna be basically building new fab sites here in the United States, and their hope is that they can get the government to back these fab sites, because right now a lot of the fabs and the chip shortage has been due to the fact that all the fabs are primarily located in Asia, and most specifically Taiwan Semiconductor is really one of the bigger players in the foundry business, and that's what they're trying to get into. Now, they're also going to be introducing some new products that I think will be very interesting, and it's supposed to be pretty competitive. They're trying to get back to that market share leadership of their CPUs, and that right now they're doing that with Alder Lake. And then they're also going to be introducing GPUs, which will be very, very interesting to see. I think they're calling it Alchemist going forward, and obviously as they introduce more, they'll have different names for it. But the GPUs are supposed to be on par with NVIDIA and Radeon from AMD. So I would not be surprised if you see some more developments from Intel as they push forward. Now, the last thing is they're trying to, they spun off their NAND business. They gave it to SK, and then also they're going to be taking Mobileye public, where Intel will hold an ownership share, but they're trying to get some cash from the underwriting of this IPO. Now, again, some of the developments and risks we're going to be going through. So Pat Gelsinger is a huge component of why I believe in this company and why I think they're going to do so well. And again, it's all relying on this all or nothing strategy. So you got to make sure you look at this company and understand what exactly they're doing. Now, the other thing that I want to point out is that they're trying to get into new businesses. So again, that foundry and the GPUs, and they're keep coming out with more and more products, and they're trying to keep this open ecosystem and be able to develop all these different products. Now, I believe the GPUs are going to be built on Taiwan Semiconductor's fabs for at least the time being, because they have the nanometer technology down. And so that's really where a lot of this comes from, is Intel's playing a game of catch up. And if you believe they can catch up, this may be a good valuation that you can get in at if you believe in the company and you do your own due diligence. Now, they're gonna be taking a hit on their margins over the next 4 to 5 years, really through 2026 is what they're estimating. So you're gonna see their gross margins drop, their profit margins would likely follow. And what they're doing is they're taking a lot of capital expenditure and putting it into the business. They're trying to build out these fabs. They're also trying to get subsidies from the different governments that they're going with. So they're going to be doing a lot of growth in the next couple of years. And that's really not good if you're looking for a heavy cash flow business that is strictly spitting out a ton of free cash flow. They're going to be taking a lot of that free cash flow and putting it back in the business. So your free cash flow yield is going to be really, really low, at least for the next 4 to 5 years. They believe that this will help them get to higher levels and be able to grow their business out more. So it's really all about what you think of the business and what you think of their strategy. Now, some of the valuation metrics, they believe that their ROIC, so the return on invested capital, is around 10 to 15% for the last 10 years. Their PE currently is just under 10. Now, their forward PE was around 13. And then obviously their enterprise value to EBITDA is around 5.5 to 6. Their dividend yield is currently at 3%, and then obviously they're trying to build this dividend ever so slightly. So don't expect crazy dividend growth from at least the next couple of years from what we understand. But, they're giving a good dividend, honestly a 3% guaranteed dividend as they keep issuing it out. And they're not issuing a lot of their free cash flow or anything like that. I think it was around like 30% payout ratio. So they're not issuing a ton of their free cash or any sort of earnings on the balance sheet. So that's really good. Now, one thing I want to know, I am currently buying this. I have a position already. I'll maybe pop it up on the screen here so you can see where I'm at, but I am currently buying. Now, next we have Facebook, or more specifically Meta. Now, they have two different segments that they're focusing on. You have your FOA, and that's going to be your Facebook, Instagram, any of the other social medias that they come out with. Facebook Messenger, I believe, falls under that, and so does WhatsApp. And then they're going to have the Reality Labs, so their FRL. FRL is going to take the Oculus and any other sort of metaverse-styled things that come with that and put that under that segment. Now, they're growing huge on their advertising side and on their FRL side. The only thing is, though, on the earnings side of FRL, they've actually, I believe it was $10 billion through 2021 is what they lost. So as we start seeing sales ramp up, we have to focus on the profit margin of that segment. I'm not worried about the advertising business. Honestly, it's going to follow the cycle of everyone else that is advertising on their platform. So, if we see a huge pullback in the economy, obviously Facebook's going to get hit. The only downside of this company versus something like Google, this is their primary driver of sales and primary driver of money. So if we see a huge recession or anything like that come in the next couple of years, Facebook could get hit pretty hard. But I think the probability of this company doing well, especially at the current valuations, it's really ideal if you're running like a probability scale. Now, again, the developments and risk, they're buying back almost 7% of their shares, or 7% of their outstanding shares, so really 77% of their market cap. And then the other thing is that they're growing in other countries and other regions. It's not just like the US is, the only thing that's growing. They're growing really, really well in other countries. The only thing is that they're subject, because of the nature of how big they are and because of the nature of their business, they're subject to a lot of political risk. And I think that a lot of people going into this company see that and think it's scary, which other people see that and they don't mind. So I would definitely do some due diligence on this one. The other thing I wanted to touch on was they're spending a lot of money in capital expenditure on FRL. If you're not comfortable with that and you want to wait to see it build out a little bit more, totally fine. And then obviously there's a lot of privacy changes that are happening from Apple and from Google in terms of on Android and on iOS. And these things impact Facebook. They have acknowledged it, and that's why their guidance for the full year, or actually really for the first quarter, was around 3 to 11% growth, which that's why the company dropped 20% in one day. So if that's something you're not comfortable with, or you feel like you need to look into it more, do your due diligence. I've done a lot into this, and I've really read into it and talked to a lot of people who are familiar with the social media space, and I feel comfortable with my position. So I'll just show it up here real quick. And then lastly, let's just hop into some valuation metrics. So their average ROIC has been anywhere from 15 to 25% over the last 10 years, and that's been growing. I believe the last couple of years it's been around 25%. Their PE as of right now, and this was around 207 in terms of the price, is 15, and it got to 184 just a couple weeks ago. This is crazy market, I know, but Their forward PE is around 15, so they don't expect a lot of growth, at least the analysts don't, over the next year, and that's totally fine. You know, if we can get this company at a 15 PE, even lower, if they can keep the fundamentals of the business where it's at, totally comfortable with that. Obviously, their enterprise value to EBITDA is 8.7. They don't have a lot of liabilities in general on their balance sheet. A lot of it is, it's not an asset-heavy business, so they just really hold a lot of cash, and they can pay for whatever they're expensing. So that's why I don't worry about the FRL business that much, because they have the free cash flow and they have the earnings and everything going into this project to really make it work. If they don't and they learn something from it, I'm totally okay with that too. Obviously, businesses, not everything works, so that's kind of the risk going in. As I mentioned, they have $38 billion of repurchasing left, and that's about 7% of their market cap at the time of when I was making this. Obviously, my position in this, I'm buying the dip. As this keeps going down, I'm going to keep buying the dip. I'm comfortable where my position's at, but again, if we get to silly pricing, I'm just going to keep buying. But again, I have, I think, 20-25% of my portfolio in this right now. Not looking to go too far higher than that. Now, the next thing is Corsair. Corsair Gaming builds peripherals, meaning keyboards, mice, headsets, and they also have components. So think your RAM, your case, your cooler, and a bunch of other things that go into that. And really, for me personally, this is my play on the gaming space and the esports space. I know Logitech is a very good value in terms of their PE, but I think that overall, I'm trying to get into the gaming and esports space specifically, so I didn't necessarily go with Logitech because I like the valuation that Corsair is currently at, and I like the trajectory that they have, and I really like the gaming and esports space as just a gamer myself, so I think that I'm comfortable with it. They make the majority of their money right now from the component side of the business, but their peripheral side of the business has been growing huge. And really, the peripheral side of the business not only includes keyboards, mice, and headsets, there's also a brand underneath Corsair called Elgato, and that's really streaming. So anything streaming related, they sell. So that's going to be your mics, your lights, your Stream Deck, anything that goes into it, they sell. And there's really not a competitor in the same way in terms of Elgato's offerings that they have been able to find. At least I haven't been able to find anyone that's comparable. Elgato definitely has a big hold on the streaming space, which is also something I like a lot. Now again, some of the developments that they have, they own about 42% of the market share in terms of gaming components, and this excludes memory. And then also for the gaming memory, they have 60% market share. And this is from their own Investor Day presentation. So obviously there's going to be some bias in how they report these numbers. Take that into consideration when you're looking at this. Now, the other thing I wanted to point out is that in terms of keyboards, their total share is 22%, and their total share over $200 is about 39%. And then for PC headsets is at about 15%, and their PC headsets over $200 is about 29%. And again, the company has talked about this, the leadership has talked about this, but right now we've had a chip shortage. Just mentioned with Intel, but they've had a chip shortage. As GPUs become more and more available, we'll start to see more and more computers get built out. But until that continues, the chip shortage really in general gets fixed, they're going to have a hard time struggling creating products themselves and keeping inventory, as well as people buying new things to build computers with. And really, it's this whole refresh cycle that I think will happen with computers because Intel's putting out new technology, AMD's putting out new technology. We're starting to see a ramp up in the competition between the two companies. And then obviously as Intel comes out with the GPU and we're going to be competing with AMD and NVIDIA, that'll cause a lot of people to get into computers, and it'll obviously drive the price down on components, at least for the GPU and the CPU. And so a lot of people will build computers and that refresh cycle will start. This happened back in 2015, 2016 timeline too, where AMD kind of came out of nowhere and took the whole computer really industry by storm, and people started building AMD computers. So I really do think that there's some potential there. Now, as far as the valuations go, the PE is around 13 and it's around 16. The forward PE is around 13. And then the ROIC, we don't have a lot of information on this. They've been bouncing in between 5 to 10%. They've only been IPO for just under 2 years, I think. I think it's been a year and a half almost now. And then their enterprise value to EBITDA is around 11.4. And then the last thing I want to mention, their financial health, as far as their debt and their liabilities, they've been able to have that debt from about 500 million to 250 million. Now, the 250 million is still a lot on their balance sheet. They still owe a lot, but they were able to refinance it down and save themselves a couple $1,000,000 of interest a year. And I think that's a big thing in terms of they recognize that that's a risk. They really think that it's important for them to pay down the debt, and they want to make acquisitions. So they need to free up some of the interest and some of the credit really to be able to make more acquisitions and build their company even stronger. Now, you may be asking yourself, am I buying? I'm adding as we go down. I'm not trying to build this into too big of a position. I think at one point it's around 4 to 5% of my portfolio. As this goes down more, I'll keep adding, but I'm not trying to make this too huge of a position because, again, there are some risks involved, and this is a small company. So a lot of things can happen just based on the market cap of this company. It's around, I think, like $2 or $3 billion. It's a very small company. So for me, there's a lot of risk involved, and I think that's something that should be acknowledged. Now, the next company I want to get into is Teradyne. I'm not going to lie to you going into this. I'm not the most well-versed in this company, but I wanted to add it to this list because I think it's one that I'm going to look into more because I think that the business that they're in is very important. But again, I'm not too well-versed in this right away, but I just want to explain something to you because maybe there might be someone else out there who has a better idea than I do. Now, Teradyne is in the semiconductor testing. So they test the wafers, they test the chips, they test the microcontrollers, basically everything that goes into testing semiconductors, Teradyne makes. There's also a couple other players out there, but I think that Teradyne is one of the best financially health-wise to get into, and they also are a big player in this space. There is a lot of competition. They're a big player in this space. Now, they're broken up into 4 components. So you have your semiconductor test, your systems test, your wireless test, and industrial automation. The semiconductor test is really the big kahuna in all this, and really what that is anything that revolves around semiconductors, so whether it's the wafers, the chips, the controllers, anything that goes into semiconductors, and this is also, across different industries. This isn't just one specific industry. So any sort of semiconductor, they make tests for this, and they work with customers and clients very closely. And one of the things that I wanted to point out in all of this is that Taiwan Semiconductor, TSMC, actually is one of their biggest customers in terms of total sales that they have. So for revenue, to give you guys an example, Taiwan Semiconductor, a customer of the semiconductor test segment, accounted for 12 and 15% respectively in terms of 2020 or 2021 and 2020. So 12% in 2021 of the consolidated revenues. So in total of the revenues, one company made about 12% of those revenues, which I think is pretty huge. And they mentioned it over and over in the 10K from what at least I've read so far, that one of the big downsides or risks of this company is that they only have a few customers that make up a large proportion of their revenue. And this can be a risk where if we have any sort of downturn or any sort of political risk, like Taiwan is based in Taiwan Semiconductor is based in Taiwan, if we have any sort of political risk or any sort of tariffs or anything like that, it can greatly affect this company and it can hurt their bottom line and top line in terms of the demand. And I think that in terms of semiconductors, that's kind of the risk playing the semiconductor space, is there is a cyclicality to this. So that is one of the risks that I wanted to point out in terms of if you're going to get into this, make sure you understand where we're at in the market cycle for semiconductors as well as the valuation that you're getting in at. The other thing that I wanted to point out was that they have, so I'm just going to quote this straight from the 10K. So they said, we enter 2022 with long-term test and automation demands trends in place, and we've increased the midpoint of revenue and non-GAAP earnings per share estimates in 2024 earnings model to $49 billion and $8 respectively. However, in 2022, we expect a slower technology transition in one of our major end markets to result in a lower system on a chip test demand for Teradyne before accelerating again during the ramp of 3 nanometer production in 2023. In industrial automation, we expect high growth to continue in 2022 on the strength of favorable global economic trends and powerful value our automation products provide to our customers. So again, there's some cyclicality to this. If customers aren't buying more of their products due to waiting for a certain technology to come out or certain nanometer technology to come out, it can hurt their bottom line. So you have to, when you get into something like this where it's basically the whole shovel and picks method where they're producing the tests, but someone else is producing the product for the end consumer, and you're simply a supplier of a test. Any sort of change in demand will hurt the company, and they're trying to get away and trying to smooth out that cyclicality, but right now they're still dealing with it. The last thing I want to talk about as far as developments and things that you may look at, the Teradyne's board of directors declared a 10% increase in the quarterly cash dividend to 11 cents per share, and that's about 38% or 0.38% of the stock price. And then the company also expects to repurchase a minimum of $750 million worth of its common stock. So right now it's at about, I think, a $19 billion market cap. So around 1% is what they're repurchasing, but they've been actively repurchasing more and more and more. And one thing I wanted to note too, their liabilities as far as their long-term debt goes, at least, it's almost non-existent. They're working on it, and they've been working on it. They have a lot of cash on the balance sheet, and they're producing a lot of cash. They've been using a lot of cash that they've gotten from this sort of up cycle, or at least upswing on the cycle right now, to really help out the shareholders and implement things into their business to make sure that they're financially healthy and pay down their debt. So that's something you want to see. But again, the cyclicality of this may be kind of scary for some people who don't understand the industry or what they're getting into. Now, as far as the average ROIC, over the last 5 years, it was around 10 to 20%. Not really surprising over the last 3 years to see that it's that high, just given the whole, upswing that we've been seeing. But if you look back farther in 10 year, like into the 10-year mark, it's gone from negative to about 20%. So it's been bouncing up and down as we kept going. And again, this goes back to there's a lot of cycle in this in terms of the semiconductors, and it's something you should watch out for. Now, the PE currently is about 20 to 21. I've seen it bounce in between there. And their forward PE, at least for the 2022, is going to be about 22. And then their enterprise value to EBITDA is around 12. And they're a little bit above where I would feel comfortable in terms of their price to book and their price to sales. So make sure you look at that too and see if you're comfortable with that in terms of theirs versus the rest of the industry, the semiconductor industry. I just really think that looking at this, I like where the management's going. I like the cash flow. I like the financial health of the company. But really, what is the valuation like? That's what I'm trying to look into more as far as the valuation and just the industry as a whole, where we're at in the cycle. Because there's still a lot of uphill to go as terms of the upswing in this cycle. I'm totally fine with getting into this, but right now I don't know enough about the industry to really make the determination, and so for right now I'm still researching. So the last company that I wanted to mention to y'all is Footlocker. Now, Footlocker, where do I even start with Footlocker? Footlocker is what would normally be a value investor's dream because the valuation is so low. It's so low, and it dropped even more because of a recent announcement that we're going to talk about here in a moment. So their business model, they sell footwear, they sell apparel, they sell footwear accessories, and just different accessories. Really just think of general apparel is what they sell. But really their focus is on, modern shoes and really high-end shoes as far as streetwear and also in sportswear, the higher-end shoes. So basketball shoes are a big component of that. Now, they own Footlocker, Kids Footlocker, Champ Sports, Eastbay, Atmos, WSS, Foot Action, and Sidestep. And I had no idea that these other companies fell under Footlocker. I knew they owned Footlocker and Kids Footlocker, obviously, but some of these other ones I had no idea. And these are all mall-based companies for the most part. They do have a lot of online presence with these companies, but for the most part, you'll see like a Footlocker, Kids Footlocker, Champ Sports. You'll see that in a mall. And that's kind of where I'm afraid of. I did a video on Nordstrom if you want to see it, but I'm afraid of just mall retail in general, or just brick and mortar in general, because I think that we were at the top of the cycle towards the beginning of this year into the end of last year. And I think that we have a lot more ways to fall, but that's my own personal opinion. You may come out with a different opinion on this, but that's why I'm still researching this company to understand where we're at in terms of footwear and where this company fits in the my thesis going forward. But one thing I wanted to explain is just the development and risk. So development-wise, the further the The board of directors declared a quarterly cash dividend payment of 40 cents per share, a 33% increase from the prior 0.30 cents per share back to pre-pandemic levels. Now, the dividend will be payable in April. Obviously, they're still trying to get a hold of their finances and figure out where they're at. They had a dividend prior to the pandemic happening, and they've been trying to implement it back, but they said they're going to review it on a quarterly basis, so you can't really count on this dividend, especially not right now where this company is at. Now, they're going to be repurchasing 1.2 billion shares of common stock. And right now, the company's at about, I think, is a $2 to $3 billion market cap. So you may see a lot of gains just simply from repurchasing the common stock. So it's almost 30-40%. Is that good math? Almost half, of their common stock they're going to be repurchasing. So that's a pretty big thing. But here's the risk. A big component of their sales was Nike. So they had a 70% of their 2021 sales was Nike. And they're estimating that in 2022 and going forward, only 55% of that will be Nike. And what's happening is Nike is taking their product, and instead of wholesaling it to Footlocker to sell to the customer, they're just going to go direct to consumer. And that's where I think I'm not understanding where the risk is. For me, at least, I see this whole companies getting into more direct consumer play. Corsair is getting more direct consumer as well to keep their profits. The thing is, though, is that you look at a company like Nike, and they control their own brand so much that people are more than likely going to buy from Nike before they buy from Footlocker. Footlocker is just a reseller at the end of the day, if you want to think about it like that. They have their own branded stuff, but for the most part, they resell other brands' footwear, other brands' apparel. And it's not that Nike's completely tearing all their stuff out of Footlocker, but they're going to be giving them less. It'll make up less of the sales. And I think that for me personally, that's a little scary because now you have your primary customer, or not really even customer, primary sales driver, suddenly removing some of their sales capacity. So for me going forward is, do I think management can handle this and build their company out even more? That's the question you have to answer, and that's the question I have to answer. That again, that's why I'm still researching this. Now, as far as their average ROIC, the last 5 years, it's been around 0 to 4%. It's a retailer, so they don't have super high margins. Not surprising, but what scared me was they had negative ROIC even before the pandemic had happened. Obviously, during the pandemic, they had negative, but they had negative even before. So that's a little scary. I think that the mall businesses are starting to go out of style, and companies either A, need to kick up their online sales and not die out, or B, they just need to get out of malls entirely. So I don't know. That's just my opinion though. So we're gonna keep going. The PEs are around a 3 to 4, and then their forward PE is around 7. Their enterprise value to EBITDA is around 3.78, and then they're repurchasing again around half of their market cap currently. So again, I'm still researching this. I really don't think I'll come to a positive conclusion for this company, but I have a lot of people that I know that are either getting into this or talking positively about this. So I just figured I'll take a look and see what I can find. As far as the end of the video, thank you all for watching. Remember, if you're gonna look into any of these companies, let me know what you know down in the comments below. If you're buying these companies or you already own these companies, let me know what you know down below, and we'll see y'all in the next one. Have a great day, y'all. Thank you. Goodbye.